Welcome back to the Pro Ticker Podcast, your Wednesday morning edition covering major financial magazine headlines, everyone. Today, we're embarking on a deep dive into the financial currents shaping our August 27, 2025. We've got a formidable stack of sources, insights from top financial magazines like Bloomberg, MarketWatch, The Wall Street Journal, and Barron's. Our mission is to cut through the noise, extract the most important nuggets, and give you a shortcut to being exceptional well-informed about the biggest stories impacting global markets right now.
And it truly is a dynamic landscape today, isn't it? From the crucial pulse of tech earnings, particularly with Nvidia, to the intricate dance of global trade policies, shifts in broader market sentiment, and even the surprising resilience of major currencies. We'll unpack these diverse headlines, connecting the dots so you can see the bigger picture and understand what it means for you.
Okay, let's unpack this with what seems to be the market's biggest single event today. Nvidia's highly anticipated earnings report. This isn't just another tech announcement, is it?
It's anything but. And what's fascinating here is just how critical Nvidia has become. As Bloomberg and Barron's highlight, it's currently the world's most valuable company, commanding a $4.4 trillion market capitalization and an 8.1% weighting in the S&P 500 index. Its performance today isn't just about one company. It's a real-time stress test for the entire AI narrative, exposing how deeply entangled tech valuations now are with, well, geopolitical policy shifts. It's unequivocally the bellwether for the entire AI story.
And a huge part of the story, as highlighted by Bloomberg, is the ongoing China conundrum. Nvidia's sales in China have taken on new levels of complexity, causing significant confusion for Wall Street. It feels like a moving target.
Absolutely. Nvidia's China revenues have been a thorny issue since the Biden administration restricted advanced AI chip sales back in 2022. It's gotten even more complicated under President Donald Trump, who initially halted chip sales in April, then dramatically reversed that order earlier this month. But there's a catch. The U.S. government now gets 15% of the proceeds. And just to add another layer of complexity, Beijing is reportedly urging local companies to avoid Nvidia's less advanced H20 processors, pushing for homegrown alternatives. This constant back and forth is causing major headaches for analysts trying to model future revenue. For example, Susquehanna's Christopher Rowland is refusing to put H20 sales back into his model, while UBS's Timothy Arcuri believes their inclusion could lift Nvidia's forecast by as much as $3 billion. It's a huge spread. We saw Advanced Micro Devices Inc. shares tumble recently after they couldn't provide a clear China outlook, showing just how skittish investors are on this point. It's a true policy tightrope walk.
Given that sheer volatility and those rapidly shifting geopolitical sands, how much confidence can Wall Street genuinely have in these revenue and EPS forecasts? Are analysts truly equipped to model for such an unpredictable environment?
That's a critical question. Wall Street, according to Bloomberg and Barron's, expects Nvidia to report $46.2 billion in revenue for the second quarter, and adjusted earnings per share of $1.01, both roughly 50% up from a year ago. Big numbers. For the third quarter, consensus estimates project revenue of about $53.5 billion and adjusted EPS of 1.21. Investors are, of course, eagerly awaiting CEO Jensen Huang's remarks on China, including any updates on the B30 chip development, which could replace the H20. But beyond the China question, the report is also a crucial read into overall global spending on AI technology. The expectation is for both results and guidance to be a couple billion better than consensus, and any miss could cause a truly volatile reaction. Bloomberg notes that options traders are pricing in about a 6% move in either direction for the shares the day after results. That tells you the level of uncertainty.
But the Bloomberg article also notes that demand for Nvidia's Blackwell chips in other markets is so strong that they could beat estimates without any contribution from China. So how important is that China outlook really to the company's actual performance versus market sentiment?
That's the nuance, isn't it? As David Wagner of Aptus Capital Advisors puts it in Bloomberg, the overall story in Nvidia can still play out with everything else going on. Any inclusion of revenue from China in that scenario is just icing on a cake.
Just icing, huh?
Well, yes and no. Because with the stock less than 1% from a record high and up 35% since May, a strong China outlook could be key to keeping the rally going. So while the underlying business may be robust elsewhere, the China narrative holds a disproportionate sway over investor psychology and short-term stock movements. It's a high-stakes moment for the stock, revealing a new layer of market risk and opportunity. And to quickly connect a related point, the tech chart of the day from Bloomberg highlights that Chinese AI chip designer Cambricon Technologies Corp swung to a record profit in the first half. That reflects a wave of demand for homegrown technology after Beijing encouraged its use. This shows the dual narrative at play. While Nvidia faces hurdles in China, China itself is still heavily investing in and developing its own AI chip capabilities.
That Nvidia story is complex, but it makes me wonder how the big money is positioning itself for the broader market, given this kind of specific corporate and geopolitical volatility. And what Bloomberg's reporting on hedge funds and the VIX shows us is genuinely intriguing. It almost feels like they're betting on a kind of eerie calm.
You're right to highlight that connection. According to Bloomberg, hedge funds are shorting the SIBO Volatility Index, or VIX, at rates not seen in 3 years. They were net short futures tied to the VIX by roughly 92,786 contracts in the week through August 19th. That's a big number. The VIX remains below 15 after sliding to its lowest level of the year, following Federal Reserve Chair Jerome Powell bolstering the case for a September interest rate cut. The core insight here is that extreme positioning and volatility isn't just a bet on calm. It's often a bet against the unpredictable.
So, what does this extreme positioning tell us? Is this a sign of genuine market confidence and continued stability, or are traders simply becoming complacent, almost tempting fate?
Chris Murphy, co-head of derivative strategy at Susquehanna, suggests it could be either. Could go both ways. Historically, such eerie calm and extreme positioning has often foreshadowed a spike in turbulence and stock losses. We've seen this before. Well, we saw this in February when trade fears caught pro-traders off sides, and in July 2024 before the unwinding of the yen carry trade, where investors borrowed in low-interest yen to fund higher-yielding assets elsewhere that created significant market turbulence. The market is either supremely confident or setting itself up for a stark lesson in complacency, where the very act of dismissing risk creates the conditions for its sudden return. For your portfolio, this means considering whether the current calm is sustainable or if potential shocks are being underestimated.
That's a critical point about complacency. On a related note, we're seeing another significant market trend, reported by MarketWatch, which is the unprecedented pace of stock buybacks. This seems to signal corporate strength, right?
Indeed. Corporate America passed a significant milestone on August 20. Share buybacks for 2025 reached $1 trillion at the fastest pace ever. Completed buybacks are projected to surpass $1.1 trillion by year-end. Jeff Rubin and Christopher Perkowski from Birini Associates Forecast announced buybacks will hit $1.3 trillion by year-end, which translates into $1.2 trillion, another record, for 2026. This level of buyback activity is truly remarkable and represents a massive return of capital to shareholders.
That's an incredible pace. But while some see this as a sign of corporate strength and shareholder returns, isn't there an argument that this cash could be better utilized for R&D, wage increases, or capital expenditure for long-term growth, rather than just boosting short-term earnings per share?
That's a valid counterpoint, often raised by critics.
Absolutely. From one perspective, these buybacks demonstrate confidence in future cash flows and efficient capital allocation. However, from another, it raises questions about long-term investment versus short-term financial engineering. Where should the money really go? Interestingly, an analysis from Barclays, also highlighted by MarketWatch, found that institutional investors, often considered smart money, have followed retail investors by increasing their exposure to stocks throughout the summer. This is likely driven by the depressed volatility we just discussed, suggesting a broad-based appetite for equities in this calm, buyback-fueled environment. It seems for now the market is favoring the shareholder return argument.
Meanwhile, across the pond, the euro is demonstrating a surprising resilience amid what seems to be perennial political turbulence in France. How is it managing to shrug off these concerns? Seems to happen a lot. Bloomberg reports that currency options show robust appetite for the euro, suggesting it's managing to dodge the fallout from French political turmoil once again. Contracts that pay out if the euro climbs had one of their strongest sessions this month on Tuesday, even as French assets were under pressure amid speculation of a government collapse. Traders, it seems, are treating this as a domestic French story rather than a concern that could spill over into the broader euro area, containing it, so to speak. What's particularly fascinating here is that the U.S. dollar's moves, especially concerns about threats to Federal Reserve independence, a topic we'll touch on shortly, have largely dictated the euro's path more than French politics. This highlights how global macroeconomic factors often overshadow localized political drama for major currencies.
That's a great segue into how policy decisions and global dynamics are creating ripple effects across different economies, reaching far beyond Europe. Let's talk about the new tariffs impacting Indian exporters. What's happening there?
Indian exporters are indeed being significantly rattled by President Donald Trump's new 50% tariffs, which took effect today. These duties doubled the previous 25% rate and are now among the highest in Asia, effectively making Indian goods uncompetitive in the U.S. market. India, which exported $87.4 billion worth of goods to the U.S. in 2024, about a fifth of its total merchandise exports, is now seeing buyers shift orders. They're moving to countries like Bangladesh, Vietnam, and Cambodia, where tariffs are around 20%, much lower. Footwear exports to America, for instance, could plunge as much as 90%, according to Bloomberg. That's a huge drop.
This sounds like a significant blow, particularly for labor-intensive industries. What kind of support are Indian industries calling for, and what's the broader geopolitical context of this sharp escalation?
Well, industry groups like the Federation of Indian Export Organizations are pushing for immediate government stimulus. Things like cheaper loans, wage subsidies and tax breaks, warning of production stalls, and significant layoffs. They're worried. This move marks a sharp deterioration in U.S.-India ties. Trump has specifically slammed India for buying Russian oil, a point New Delhi has consistently defended. They're calling Washington's actions unfair, unjustified, and unreasonable. Strong words. While key exports like electronics and pharmaceuticals are exempt from these new tariffs, labor-intensive industries like textiles and jewelry are hit hardest. Bloomberg Economics notes that New Delhi will likely prioritize strategic autonomy while staying engaged with the U.S., but this puts significant pressure on their trade relationship, and it could force a recalibration of global supply chains for many U.S. businesses. You might see shifts there.
So we're seeing tariffs used as a geopolitical tool, and connecting to the U.S. policy front, Barron's reports on what's being called the Trump administration's Accidental Sovereign Wealth Fund, and the potential implications of government equity stakes in private companies. This sounds like an unusual development.
It is, very much so. The Trump administration, with its 10% stake in Intel, 15% stake in MP Materials, and now receiving 15% of Nvidia and Advanced Micro Devices chip sales in China, it's accumulating what some are calling an accidental sovereign wealth fund. Commerce Secretary Howard Lutnick even mentioned potentially taking stakes in defense firms like Lockheed Martin. It's certainly a unique approach to industrial policy, blurring the lines between government and private enterprise.
But is this a good thing for the economy or for innovation? What does this kind of government involvement mean for the private sector and the efficiency of capital allocation?
That's a critical question, and one that finance professors like Velko Fotak and Bill Megginson caution against. They note that most state-run funds globally are indifferent investors and bad at driving development and innovation, often suffering from political interference. That's the big risk. They point to exceptions like Norway and Singapore, which managed to insulate their funds from politics. But those are rare. The concern, as noted in Barron's, is that if the government's aim is political influence or patronage, rather than sound investment principles, it could lead to poor performance and distort markets. Especially when private capital isn't lacking for companies like Intel. They could raise money elsewhere. This raises an important question about the appropriate role of government in private enterprise and whether these stakes could ultimately stifle rather than spur innovation if politics become the primary driver. This discussion also ties into those broader concerns about the independence of the Federal Reserve we briefly touched on earlier. MarketWatch highlights that President Trump's attempt to fire a Federal Reserve governor could undermine confidence in the U.S. dollar and Treasury bonds,
potentially making gold a safe haven of choice for investors, a shift away from the dollar. What's fascinating here is that the muted reaction from financial markets to these threats has surprised strategists. It suggests markets may not be properly priced for a rupture in the monetary policy process, according to Evercore ISI. This could be a significant unpriced risk for your portfolio, should such an event materialize, something to watch closely.
Pivoting to another interesting corporate story from Japan, let's talk about Metaplanet Inc. and their deep dive into Bitcoin. We've seen companies like MicroStrategy make big bets on Bitcoin, but Metaplanet seems to be taking a slightly different approach, or maybe doubling down.
You're right to note the evolution. Bloomberg reports that Metaplanet, a hotel operator that transformed into a Bitcoin buyer, plans to raise up to $130.3 billion. That's about $880 million, by issuing new shares in overseas markets. The proceeds from this issuance will primarily fund Bitcoin purchases and options trading on the cryptocurrency. This is a new financing strategy after its shares tumbled 53% from a June peak, so they need the cash. And they've engaged Morgan Stanley and Cantor Fitzgerald as bookrunners, big names involved. It largely follows the playbook created by Michael Saylor's MicroStrategy in terms of using equity issuance to accumulate Bitcoin.
And speaking of crypto, Trump Media and Technology Group also has a big announcement regarding digital assets, but it's focused on a different part of the crypto ecosystem, isn't it? Not Bitcoin.
Precisely. Bloomberg also reports that Trump Media and Technology Group Corp. and Crypto.com have agreed to a deal with a blank check vehicle, essentially a shell company created to merge with a private company to take it public, Yorkville Acquisition Corp., to create a crypto treasury company. This new entity will be focused on buying and holding CRO tokens, which is the native cryptocurrency of the Kronos ecosystem.
This differs significantly from the Sailor Metaplanet strategy in its focus on a lesser-known cryptocurrency rather than Bitcoin. It also includes a mutual cooperation agreement to introduce a reward system on Trump Media's platforms that will adopt CRO as a utility token, basically a digital asset that grants access or utility within a specific ecosystem and use Crypto.com's digital wallet infrastructure. Eric Trump, a strategic advisor, is even planning to attend a shareholder meeting next week as part of this crypto push. It underscores how different companies are carving out diverse crypto adoption strategies. It's not just one thing.
Finally, let's address the big question looming over the tech sector. Is AI killing traditional software? The Wall Street Journal suggests software's death by AI has been greatly exaggerated. What's your take?
Indeed, initial fears were that AI tools like ChatGPT could enable vibe coding, generating functional software code from vague natural language descriptions, and render pre-made software obsolete. This sentiment was even echoed by Nvidia CEO Jensen Huang back in 2017. However, recent earnings from companies like Okta, as highlighted by MarketWatch, show that AI is actually proving to be a tailwind, a boost.
A tailwind? How so?
Okta, which provides identity authentication, is benefiting from what they call the identity quagmire of AI. That's the complex challenge of securely managing the identities and access for numerous AI agents and applications within an enterprise. It's a new problem AI creates.
So it's not killing software, but rather creating new opportunities and integrations.
It's exactly highly complex, mission-critical enterprise applications in areas like human resources and finance. As noted by Workday CEO Carl Eschenbach in the WSJ, are not easily replaced by nascent AI startups. They're too embedded. Instead, companies like Salesforce and Workday are furiously integrating AI into their own products. They recognize that multi-agentic systems, where multiple specialized AI agents collaborate across different software applications, are the real opportunity. Analysts like Brent Thill of Jefferies emphasize the meaningful complexity of enterprise architecture makes full AI disintermediation of software unlikely, especially given recent stumbles by AI companies like OpenAI's GPT-5 rollout, which faced criticism for inaccuracies. So the software industry is adapting and evolving, rather than dying, by becoming this scaffolding for the AI revolution.
As we've explored today, we're seeing a fascinating interplay between individual corporate narratives, like Nvidia's earnings, and sweeping geopolitical shifts, like U.S. tariffs or the debate around Fed independence. For your understanding of the market, the key takeaway is often how these seemingly disparate stories, from hedge funds betting on calm to governments taking equity stakes, ultimately converge or diverge to paint a coherent picture of our global financial future. Are we entering an era where specific corporate events or political decisions hold disproportionate power to sway global markets and redefine investment strategy, perhaps even more than traditional economic indicators? It's certainly something to mull over as you navigate the coming days. We'll see you all tomorrow morning with new headlines from major financial magazines.